Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and today I want to talk to you about war, oil, and Australian property, because there's a lot going on in the world. I don't know if you've been following the news. I'm not a massive fan of the news, but when this started happening and some of the economists and some of the influencers that I follow started talking about it, I started digging a little bit deeper, because sometimes chaos equals cash, right? And if you're a property investor, then you want to make money, right? And in times like these, a lot of people pull back and sit on the fence. And as you know, say if you sit on the fence for too long, you get splinters in your bum. But the people that don't sit on the fence, the action takers, the people that thrive on uncertainty, the ones that always make money during these times. So I want to talk to you about a few different things, right? I want to talk to you about the Middle East being on fire, Iran, Israel, US strikes, the Strait of Hormuz, one of the most critical shipping lanes on the planet, and it's effectively closed right now as I'm recording this podcast, and oil prices are spiking. I don't know if you tried to fill your car up recently. Petrol prices have gone through the roof, and the news cycle is doing what it always does, right? And that is selling fear. And look, you should be concerned about certain things, but your concern should not be what you're thinking about, right? Because like I say, chaos equals cash, and a lot of people in times of uncertainty sit on the fence, right? People love certainty over uncertainty, but uncertainty is tied to fear and certainty is tied to greed. And Warren Buffett says, observe the masses and do the opposite, right? So if everybody's pulling back and sitting down, there should be times that you tie in, because I don't know if you've witnessed what's just happened during COVID. The world slowed down, everything went up in price, and one thing that you should realize by now that is tied to inflation is the price of hard assets like real estate and gold and oil, right? You don't even have to look back that far. We're not even talking about historic events. COVID feels like yesterday, right? And right now, there is some crazy things going on in the world, and I believe it is going to spike the price of real estate even further. And if you're not looking at the same things I'm not looking at, please look into them and please look back and see what's been happening. So because what you're hearing in the media is incomplete, on February the 28th this year, the US and Israel launched strikes on Iran. Iran's supreme leader was killed, and with 48 hours, Iran declared the Strait of Hormuz closed. I actually listened to a very, really good podcast with a guy on the Diary of a CEO, Stephen Bartlett, and there was a guy on there that had been working with the White House and the American government, and some of the things he was saying on there, absolutely crazy. So because the strait is closed, tanker traffic through the strait dropped by about 70%. Over 150 ships are anchored outside, waiting. And the four biggest container shipping companies in the world, which are Maersk, MSC, Hapag-Lloyd, and CMA CGM, have all suspended operations through the strait. And here's what makes this unprecedented, because at the same time, the Houthis resumed attacks in the Red Sea, reserving every gain made since the ceasefire in the late 2025. So look, for the first time in modern history, both major Middle East shipping corridors are blocked simultaneously, and this is not a media exaggeration, this is a fact. So what does that mean for Australia? Because the question is definitely worth answering. So I want to say something that you're not going to hear in a lot of property investment podcasts, because it's uncomfortable, and it's this: Australia is not as energy dependent as people are telling you. Yes, we export enormous amounts of LNG gas. We're the world's second largest LNG exporter. That is true. But here's what people don't tell you. We export gas and we import fuel. And these are completely different things. We export LNG to places like Asia. We import refined petrol, diesel and jet fuel from Singapore, South Korea, Japan. And a shipping crisis doesn't stop our gas export. It threatens our fuel imports, which is why you're seeing the petrol at the Bowser increasing. So Australia imports around 90% of its refined fuel. We have just 2 oil refineries left, both on government subsidies. Get your words out, Mr. Gibb. And right now we're sitting at about 37 days of petrol, 30 days of diesel, 29 days of jet fuel. The IEA's minimum requirement is 90 days, and we're only IEA country not meeting that obligation. Diesel, unfortunately, is not a luxury. It's the lifeline of the Australian economy. If you think about it, it powers trucks, mining operations, cars, construction sites, agricultural equipment, and we've only got 30 days left of it. And apparently this is what I'm finding online, right? So does that mean we're about to run out of fuel? No. The government has been releasing strategic reserves and relaxing fuel standards to access more global supply. But it does mean we are not insulated from this the way that some commentators are saying. Now, if you think about construction costs and property values, like, let's move all that risk out the side, right? Let's push that to one side, what we just spoke about, and let's talk about what this actually means for property, because this is where it really gets interesting. Is a really simple chain of logic. Shipping disruptions make it harder and more expensive to get building materials into Australia. Construction costs were already rising to 5 to 8%. We're already rising. 5 to 8% escalation was forecast for 2026 before the crisis even hit. Higher construction costs means fewer homes getting built. Hello, we are in a housing shortage right now, and builders can't make the numbers work. Fewer new homes means the existing housing supply gap gets worse, and a worse supply gap with demand staying steady pushes up values on the properties that already exist. Hence, if you are not investing in real estate right now, if you're not doing everything you can to buy more real estate right now, then what are you doing? Because I believe this is another cracking time for capital growth, and you just got to look at areas again. I mean, like we did a podcast the other week where we were talking about how many properties are on the market per person, per capita, and Perth was leading the way. Honestly, it's going to get a lot worse, right? So let me give you the numbers nationally, right? Australia needs around 240,000 new dwelling completions every single year to hit the government's housing accord target. In 2024, we completed just 177,000. That's a shortfall of 63,000 homes, and that's just in one single year. According to KPMG, we are forecast to complete only around 160,000 homes per year over the next 2 years. That's 30% below the national target. The National Housing Supply and Affordability Council says that will fall roughly 262,000 homes short of the 1.2 million target by 2029. We are not even close, my friends. Now, let me talk about the Perth numbers. And obviously we are currently investing heavily in Perth ourselves, and this is our market, right? WA's target under the Housing Accord is 24,000 new homes per year. I think that needs another 8,000 on there at least if we want to be realists. In 2024, we completed just over 20,000, the highest number since 2017, and we still fell short by 4,000 homes. New dwelling commencements in WA were around 16,900 in 2025, well below the pre-COVID average of 25,000. Build times in Western Australia have more than doubled, right? It was getting back close. It was getting back to normal, we were building houses in 8 months. But even if it takes a little bit longer to build a house in Western Australia now, judging by the fact that this is going to push housing prices up even further, I think you would still be crazy to not purchase a new build or not build a new house if you can't buy an established property. If you build a new house and it takes from, I don't know, let's say instead of 8 months, it takes 12 months, and in that 12 months you get 20% capital growth on there, then yes, you might have had a 4 to 6 month extra holding cost, but your property is probably going to increase by another $150,000, $200,000, right? It is absolutely bonkers. On the demand side, Western Australia's population grew 4.2% in the 2 years to early 2025, the fastest of any state in the country, and 85% of those new arrivals settled in Greater Perth in just 18 months. Perth added only 694 new rental dwellings in the same period. The state population grew by 119,000 people. I don't actually know where they got that 694 new rental dwellings, because if you think about it, that means only 694 investors bought properties. I don't think it's right, but it's saying this is not a typo. 694 rentals, 119,000 new residents. The rental vacancy rate hit 0.4%, effectively zero, and the median weekly rent in Perth has risen 76% since 2020, sitting at $740 a week. I just can't believe the price of some rentals right now. Can you? Phenomenal. Anyway, meanwhile, construction sector, it's not in a position to rapidly fix this. Australian construction insolvencies jumped 42% between 2022 and 2023. Builders going under because they just couldn't absorb the rising cost on fixed price build contracts. Those builders aren't coming back. And it is a shame because these builders are good people just trying to provide a better life for their families. It's not because they're bad builders. It's not because they couldn't manage cash flow. It's because the government shafted them by releasing all of these grants, and then that spiked demand, and then construction prices went through the roof and builders lost everything. Now, unfortunately, not everything goes up in this scenario. Structural steel is actually being pushed down right now because Chinese construction demand is weak and there's oversupply from Asia. Copper surpassed $13,000 per tonne in early 2026. Anything petrochemical, PVC piping, insulation, polymer products is being hit hard because those materials flow through the Strait of Hormuz. The picture is mixed, but the overall direction for construction costs is up, and that's the important takeaway. Now, why is copper past $13,000 per tonne? I don't know if anybody's been using AI lately, but the computing power required to run the servers for the likes of ChatGPT, Claude, and all of these other things that are out there now is phenomenal. Copper is going to be one of the most in-demand materials on the planet, if it isn't already. I know gold is super expensive, like $3,000, I believe, or there or thereabouts. Copper, $13,000. So what that means for Perth property investors, you have record population growth, record low supply, construction costs rising further, and build times blowing out. Every one of these forces points in the right direction, and that direction certainly isn't down. And now I just want to quickly talk about the genuine evidence-backed opportunity, right? And this one, I think, is one of the most compelling structural property stories in Australia right now, because the spending is confirmed, the locations are specific, and the timeline is long. And if you haven't heard of AUKUS, AUKUS, bang it into Google after this podcast, obviously, because I'm going to tell you all about it now. AUKUS, or AUKUS, is a defence agreement between Australia and the UK and the US. And while you might not fully appreciate is the scale of what is being built and where. So right now, around 25 billion Australian dollars is going into Perth over the next decade. Henderson Shipbuilding Precinct, HMS Sterling, that's around 10,000 construction jobs and ongoing defence roles in Perth alone. In Adelaide, the submarines themselves are getting built, a 30-year programme, and the total AUKUS programme runs to potentially 368 billion. That's billion with a B by 2050. That is just some staggering amount of money, right? And that's, if you think about where the naval base is in Perth, Kwinana, Coburn, Henderson, Rockingham, and then if you think about where it is in Adelaide as well, you can keep your Olympics, Brisbane. I know where I'd rather be. Because government money, I've worked for the Australian Submarine Corporation before, and these government jobs are an absolute rot. They throw money at people. It's quite hard to get sacked from these places, and they're probably overstaffed, which means, this 368 billion will probably end up being 400 billion or more, I reckon. Now, the thing about how property markets work and why this is important, the market doesn't wait for jobs to arrive, right? Buyers price in future demand now. Nobody's going to wait until 2029 to start buying in Kwinana, where 13,000 jobs are confirmed and construction's already starting. Smart money moves early, and everyone I speak to is talking about this area. We're picking up some sites down there at the minute. We're paying stupid money for them, but we just believe it's going to be a hot area for the next 10 to 15 years. So in Perth specifically, the demand clusters around Rockingham, Kwinana, Coburn, Fremantle, these suburbs are going to house new defence workers. They're going to house all the construction workers, and they're already under supply pressure now, and that pressure is just going to build and build and build as the programme ramps up over the next decade. Some of it, like I say, it's already priced in, and that's why the entry price and yields matter. When you don't just buy because the story is compelling, you buy when the numbers work at the price available to you. But the structural driver is real and it's confirmed, and it runs for decades, and that is rare. So the markets where I think the thesis is clearest right now: Perth South, West Corridor, Rockingham, Kwinana, Coburn, where even Fremantle, where AUKUS demand compounds on top of tight existing supply. In Adelaide, with submarine construction locking in a 30-year employment pipeline at a lower entry price than the East Coast. So the market I'd be more careful about with resource-dependent regional towns where income is directly charged to Chinese commodity demand. Hello, Port Hedland. If this conflict drags and China slows, those regions could face pressure from both directions at once, demand softening, supplies costs rising. So, look, wars are terrible, right? What's happening in the Middle East right now is causing real suffering for real people, and that matters, right? But your financial future doesn't have to become collateral damage. So just to recap on what we covered today, the Strait of Hormuz is actually closed. This is not speculation, it's actually happening right now. Australia is more fuel vulnerable than most people realise. Construction costs were already rising, and this crisis accelerates that, which constrains supply and supports existing property values. Perth specifically is facing a supply crisis, and that was already severe before any of this, and then AUKUS has laid a confirmed decade-long demand driver on top of a market that was already structurally undersupplied. The investors who build generational wealth don't do it by being the loudest voice in the room. They do it by being the most informed. They do it by taking action when other people don't. They observe the masses and do the opposite. They position themselves while others are frozen. And that's what this show is here for, guys. And that's what we're going to keep doing. Every single episode, I'm just going to bring you things that you can go off and research and look into yourself and make your own assumption about what I'm talking about is right or whether it's absolutely garbage. But I've got myself in a pretty good position over the years. A lot of my clients have too. And I'm going to keep my finger on the pulse and keep helping property investors do what they do best when they work with us, and that's make capital growth, cash flow and debt reduction in the same deal so that they can quit the jobs, retire early and live life on their terms. My name's Neil Gibb. Thanks for listening to the HMO Property Show. I'll see you next week.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.